We're going to start by talking about prices. Specifically, we're going to talk about what's happening to prices, and we'll talk about subsidies, who qualifies and how they work, and then we're going to talk about what happens if your subsidy changes or goes away this year. So let's talk about prices. Carrie, if I read the newspaper or watch the news, the headline is prices are going up about 6% on average. That's according to a PwC report from 41 states. So is 6% all you need to know? You paid $100 last year, you're going to pay $106 this year. Is that the story on prices?
Yeah, not really. The national number makes a really good headline, but we all live in specific local areas. So the research that is more relevant looks at prices at the city and county level. A report from McKinsey Group that predicted prices in some cities for some plans will go down as much as 20% or more, while other plans may go up over 30%. So what's happening to prices in your specific zip code is really what you need to pay attention to.
So let me make sure I understand. Prices are local and they're plan specific. So the benefit of at least looking at new plans and new prices once the enrollment period starts is that you can figure out pretty quickly what's happening to prices in your area.
Yeah, that's right.
Okay.
And let's talk about subsidies. If you look around at prices this year and you see, oh my gosh, I'm getting a 30% rate increase, a subsidy that lowers your cost is going to sound pretty good. So the good news is, as we said, the Affordable Care Act makes subsidies available to people who qualify. So Carrie, let's talk about qualifying for a subsidy. It's complicated. Walk us through it.
Yeah, subsidies are really based on two things. Are you eligible, and is the insurance in your area affordable? So let me break down the eligibility piece first. So you need to live in the United States, you need to be a U.S. citizen or U.S. national, you cannot be in jail, and your household's total modified adjusted gross income has to be below 400% of the federal poverty level. I know that last part sounds like a lot of mumbo jumbo, because it is. It's really confusing. So just know that it's about $46,000 a year or less if you're a single, and about $96,000 a year for a family of four. And there's two other things that I should point out. One, if you have access to affordable health insurance from your employer, chances are you won't qualify for a subsidy. And if you're married and you file taxes separately, again, you probably won't qualify. So typically you need to file jointly if you're married.
Yeah, so it's a good point. And I should just point out that only the IRS can determine your eligibility, so we're just sort of outlining the basic rules. Our lawyers make us say this. But there are exceptions, and eHealth is not the arbiter of eligibility. So, it's important to look. The second piece that you mentioned was the affordability of plans in your area. This is where it gets complex. So, Carrie, is it fair to say that you only get a subsidy if the plans in your area are unaffordable?
Yes. So if you're eligible for a subsidy, then the government looks at every health plan in your zip code, and there's one plan that sets the standard for affordability. So think of that as like your benchmark plan. The important thing to know about this benchmark plan is that if the plan is affordable for you, based on the government's definition of what you can afford, then you don't get a subsidy.
So the government looks at your income and the price of this benchmark plan. If they determine that the insurance is affordable, you don't get a subsidy. But if that plan is not affordable to you, you do get a subsidy.
That's right.
Okay.
Here are two things that you need to know about how affordability is determined. First, affordability is not based on your budget. It's based on a percentage of your income. And second, affordability will change if your income changes. So if you make more money, the plan becomes more affordable, and your subsidy could go down or even go away.
So to use this graphic that we're going to put up as an example, if the government decides that you can only afford to pay $196 for this benchmark plan, and that plan costs $400, you get a $204 subsidy. Is that right?
Basically, yes. And then you can use that $204 towards buying any plan in your area.
Yeah, it's good. It's a good question. So we talked about the fact that prices are changing in some cases very dramatically, and we talked about how those prices can really impact your subsidy. If that benchmark plan suddenly becomes more affordable, your subsidy could go down or go away. Conversely, if it becomes less affordable, it could go up. So let's talk about what happens if your subsidy does change.
If your subsidy changes for any reasons, one of two things will happen next year when you file your taxes. If it turns out your subsidy was too small, you should either get a tax refund or see a reduction in the taxes that you owe. Kind of a good thing. Or on the flip side, if your subsidy is too big, you may have to pay some or all of it back next year.
I hope what you really take away from this is that the news around prices is that prices are changing in every market throughout the country, if you qualify for a subsidy, these changing prices can really or impact what your subsidy might be.
Yeah, it sounds like the benefit of reshopping for coverage this year is that you can avoid or minimize any surprises, either like in what your monthly bill is or the bill you get from the IRS at the end of the year.
Yeah, that's exactly right.